Good morning. Welcome, everybody, to this opening panel on investors' perspectives in forestry and NBS investments. My name is Edith Kiss. I'm Chief Commercial Officer at Integrity Global Partners. We are a new venture with a mission to unlock institutional capital for high-integrity nature-based solutions. So I'm very, very pleased to moderate this first opening panel with some of the leading institutions to discuss the challenges and the opportunities for investors and explore how collectively we can accelerate the capital deployment into the space. Justin has wonderfully set the scene for us, and I couldn't agree more. I have also some of the statistics to remind us, and hopefully after that we can dive into the challenges and the solutions. So we know that nature-based solutions provide 30% of the cost-effective mitigation opportunities by 2030, and we now have official targets for nature as well. As at COP15 last year, we have finally agreed to protect a third of the planet for nature by 2030 in a landmark deal. We have also seen how fast carbon pricing can mobilize investments. We had just a year ago $15, $20 price signal. The market has been moving a little bit since then, but we have seen how that already a $15, $20 can catalyze investments, how market can react. We have now, for the first time, an emerging biodiversity and nature credit market at site. I agree with Justin, we really need to get this market scale, and we have to have a price signal. But this is now the first time ever we have standards preparing by the end of the year to be ready to launch pilots. We also know, thanks to the research by the Task Force on Nature Markets, that the nature markets represents up to 10 trillion, or 11% of the global GDP. So it's a massive opportunity space. Obviously, it's a big challenge, but there are also a lot of opportunities. Despite all of this, we are still seeing that nature only receives 2 to 3% of the green finance. And private finance represents only 17% of the total NBS space. And we have seen with the last years that while philanthropic capital and carbon markets, indeed through the corporate action, have significantly grown, impact investment and institutional finance have increased very little. And we're running out of time, as you also heard. We have 7 years left to stop deforestation and restore 350 million hectares of degraded land. We have to at least triple private capital by 2030. So, what are we waiting for? Luckily, I'm joined by 3 leading experts in this space who will hopefully help us unpack these questions. Before I introduce the panel, I wanted to actually quickly engage the audience and see how many of you are investors, just to see for the audience, if you could raise your hands if you are an investor or investment advisor. How many of you are already investing in NBS space? And how many of you are about to invest or considering investing? Some of us. So
need more hands there.
Exactly. So hopefully we'll get more hands there. So I'm very pleased to have with me today Alexandre Martin-Min, who is head of private equity at Natural Capital AXA Investment Managers, Andrew Dreaneen, head of natural capital and liquid alternatives at Schroders, and Mike Cerchiaro, senior vice president and director of investments management at Forestry Investment Associates. So maybe starting with you, Alex. AXA has started its journey quite a while ago, back in 2013-14, investing in the Althea Climate Fund, and since then has also built an in-house team and its own expertise. I was wondering if you could share some lessons learned from the journey, some of the pitfalls, and also talk about your new strategy that I believe you launched in 2020.
Yeah, and the background, welcome to all of you. The background for us back at the days where we were multi-theme impact investors with smaller funds throughout the world, education, financial inclusions, climate. So, a few years back, we looked back at what different funds have delivered, what were the key themes, and where we could have the dual bottom line of delivering financial returns and impact. Climate was one of them. The other one was is healthcare. I will not speak too much about it. So on the climate side, we realized that those projects, even I think back in the days it was $1.5 per ton of carbon So our projects were about to be break-evens with that type of amounts. We look at different business models that were mixing commercial activities, some of them that were pure conservations. So we had a good insight, and we find, amazing people able to grow projects on the ground, small developers, and as well teams here in London. So we decided to change scale, do much more direct, hire the teams that was previously at Alphilia those days, so people we knew very well. And we got a huge commitment from our parent company on these nature-based solutions, which I think was a bold move from them. 500 million nature-based solutions, pure emerging countries. Ability to do afforestations, REDD+, wetland restorations and conservations. So basically the whole spectrums of these kind of things. Now the ambitions, we've done a few trades, we keep going. I think what we would love to do is be able to open up the funds to third-party accounts. We understand that for many institutional clients, it's a high barrier to reach. Doing that, emergings, pure, driven by the carbon for the region, not much real assets into it. But that's the ambitions. Basically, was to anchor on the 500 millions that AXA has committed in this business, to anchor more institutional capital with this strong alignment of interest. We hope that maybe 5 years down the road there will be many more funds. We cannot do it on our own. One thing for sure, it's very nice to have this amount of capital, but given the scale that we need to reach, even on some projects, we need other partners alongside us, not only bilateral banks, but as well other institutional investors. So that's the journey we've been through. I think it was, I could speak hours, some of them was very challenging. There's risk in every places, changing regulations. Justin was mentioning the importance of regulations for those markets. Indonesia, we cannot sell our carbon credit outside Indonesia, so all the projects we have over there are stuck. We have a restoration of wetland developers over there. We can't do anything with it. We have nesting issues in Guatemala with the country package. So it's something very rewarding because I think we managed to deliver on top of the carbon very huge impact on the biodiversity and with local communities. And honestly, that's probably the most rewarding. It's to be able to deliver that dual impact of financial returns. Currently, I think we're on the right stuff in the 12 to 15% area, based on today's carbon market. Maybe there's more upside into it, and I think we will deliver in the low to mid-teens at the end. But at the same time, we deliver strong, very, very strong impact on biodiversity and on carbon. And that was the very key element for a parent company to move. They would have not done it just on the basis of doing emerging market investments. That's the first thing that people cut when there's a crisis. Emerging market investments, they've not done it. But its impact is a very key and very important. And I would mention one last thing that was very key, that is still very key for us, is the reputation. I think what the risk management of my parent company is always on my back, telling about the reputations. There are limits to things we can do. I think the role of government will be key for us to help us doing more things because of the reputation risk. I think on some areas like the Congo Basin in DRC, and as well in some in South America, where we had the limits and on where we can act and how we can act. But we know that those areas are key. Millions of hectares. So there could be a massive transformation, but it's too far-reaching at this stage. We hope that we'll go down this road and find a way to deliver on those projects.
Great, thanks a lot for that. And it's fascinating to hear how you managed to engage the group's assets. Do you think that there is based on this journey and experience, there is a way to double and triple this 500 million commitment to nature in near time?
We want to deliver trades first. I think probably we would increase by 200 or 300 millions. It's already a large amount. I think we have several things in the pipeline. It takes a lot of time. If you want to do, let's say, 50 to 100 million projects, it will take a year to 18 months to be delivered. So I think, I don't know if it's leading by example, but for many other large institutions, we hope it will be the case. And they will follow us, maybe initially on some projects, and at the end in a coming go fund.
Perfect, thanks a lot. Maybe moving down to Andrew. So Schroders is a bit newer to the space. I believe you entered the market around 2019 with the acquisition of Blue Orchard. So maybe if you could tell us a little bit about your journey, why did you decide, or how you entered the space, and what's your strategy?
Great. So thank you, everyone. So working at Schroders, sitting in Schroders Capital, which is our private markets platform. We run around $85 billion today, primarily private equity, real estate, infrastructure, private debt, but natural capital is a newer area for us, as Edith mentioned. We've been looking into it for the last 3 years, partly for internal mandates, which we see a lot of demand for multi-private asset impact strategies, and Blue Orchard, an impact specialist that Schroders acquired in 2019, being part of that proposition, but also cutting across all asset classes, and Blue Orchard have taken on their sort of impact skills to the broader Schroders Capital platform, so it really has added value to our credentials there. But one of the focuses has been climate, and so we have a solution that has been in the press called Climate Plus, which we offer to UK DC pension plans. It's the first LTAF in the UK, and as part of that strategy, we have an allocation to natural capital. That's also been funded by another UK institution, so in total we have about 350 million there, and a pipeline of about another 300 million. But what we've noticed in the quest for investing in natural capital is just how difficult, as Justin mentioned, it is to underwrite some of the managers and strategies out there, and also some direct investments, just given a lot of the stuff we see is pre-feasibility, it's early stage, it has very aggressive assumptions around costs, around where nature credit markets go. We see a lot of projects that are highly dependent on carbon credits going up significantly, at least 3 to 5% per annum, which is not unforeseeable, but also quite a difficult investment to underwrite if that's your forecast over the next 15 years, and we know that nothing goes up 2 to 5% per annum every year, so you're going to get some bumps along the road. But overall, what we did is we looked at the universe, we talked to the consultant community. There aren't that many consultants that are deep on forestry and farmland. There's 1 or 2, but what we noticed is even the ones that we use, you're getting about 3 to 5 managers underwritten a year, and we wanted to look at the whole universe. And so we looked at forestry, we found around 100 different managers. We looked at farmland. We focus in on the real asset side of farmland, so the managers that are managing the land, typically owning the land, in some cases, processing logistics and the full sort of supply chain, but the ownership being a key part, because we are underwriting natural capital for its sort of bedrock in a real asset perspective. The inflation of land can make up 30% of a natural capital strategy through time. So if we're going to miss out on that and just go into sort of carbon farming, then you have to have a pretty strong view on where carbon markets go. So we like the sort of security of the land, and obviously land tenure and other things are also critical within that. What we also noticed is there's this third bucket emerging called conservation, and you can slice and dice it in many different ways, NBS, NCS. Some of that plays into forestry and farmland, but a lot of that is a new segment being delivered specifically for climate mitigation, climate adaptation, focused in on generation of carbon credits. And that's a much smaller space today in the asset management world. It's around 20 or 30 funds, on average around $100 million. And in most cases, as Justin also touched on, these grant funding, blended finance, heavily dependent on concessional capital. And that could be viewed as a blessing or a curse. It's a blessing in the sense that someone's taking the first loss or providing catalytic capital, but it also shows that potentially the investment can't stand on its own 2 feet without that. And that's a hardened thing for an institutional investor to get involved with when they sort of have fiduciary responsibilities, and it's still very, very early stage. So just to conclude on what we're doing, so we recognize there is enough to do within forestry and farmland, especially in the developed markets. We see around $100 billion in forestry, around $30 billion in farmland. So we can deploy a few $100 million into those spaces quite comfortably. But within the conservation space, given it's so early, we've decided to sort of give it a go ourselves as well. And so we've partnered with Conservation International in Southeast Asia. We've created a new fund manager called Acaria, specializing in nature investments in the region, and hopefully through time more globally. And then also within Blue Orchard, have offices around the world and do focus in on microfinance and emerging markets in particular, and frontier markets, to leverage their relationship with local partners to look also at doing NBS in emerging markets. So in short, Edith, our strategy is to go indirect in developed markets through third-party managers that have scale, track record, and go direct into emerging markets, into some of these newer areas, natural climate solutions, and help to get the market going.
Great, thanks for that. Very interesting to hear. So you mentioned that you believe that the conservation segment requires blended finance. Do you see, and we'll have a DFI panel, I guess, at the end of the conference tomorrow. So yeah, look for, maybe we can discuss on that panel more. But do you see opportunities to blend with corporates or some other solutions, as we know that the public capital is scarce and philanthropic capital is slow? Are there any workarounds, or we have to wait for the blended capital?
Yeah, I think when we look at NCS and NBS, if the ultimate goal is to create strategies to protect against biodiversity loss or create carbon credits, so either avoidance or removals, then the big sort of buyers, or I say big buyers is the wrong word, but the people who are most interested in that segment clearly are the corporates today. And so you will structure strategies, I think, more there on a either fund of one basis, like you see a number of the big corporates doing, or where you look at particular clusters of corporates that have either geographical supply chains or specific commodities that they're looking to decarbonize. So I think it's absolutely a good strategy to work with corporates to help them solve for that and pull the assets together in a fund or in SMAs or SPVs or those sorts of things. Great.
So hopefully we can get some more corporates next time and engage and collaborate. Moving on to Mike. So FIA is entering this space from a different perspective. You have a deep forestry experience and coming from the forestry sector. Could you please tell us about your strategy and how you're approaching the NBS space and in the past you have been in the space for a long time, but I believe you're also looking at NBS more recently. So how was the journey and why you have decided to go into the NBS space?
Sure, and good morning, everybody. Excited to be here, and great comments to set us off, my fellow panelists. So FIA is a timberland investment manager based in Atlanta, Georgia. We manage about $4.5 billion in AUM, and what I would call more traditional timberland investments in the U.S. and in South America, in Chile and Brazil, specifically in South America. What we're really kind of excited about is really, I think, why we're all here today, is just this confluence of capital that's interested in achieving broad level solutions around climate and nature. And we certainly recognize that trend and are excited by it. And I think one of the things that we really acknowledged several years ago was our role in this space can be one of authenticity and the ability to execute on the ground. I think, I really applaud the mandates that are being executed on currently, but I think at the end of the day, we need much more scale, we need much more hands raised up, as we indicated at the beginning of our panel, and we really need execution on the ground. And I think that's really where kind of FIA has found ourselves in as an ability to kind of make sure that we're getting the execution done right across the spectrum of outcomes that we're seeking. We do see kind of this dual purpose mandate as an important one. We were trying to bridge financial outcomes alongside outcomes that revolve around primarily climate and to a certain extent nature in these early stages. So I think what our role and our strategy has been is to work with institutional capital at scale to help them understand the role of sustainable forestry and help them understand how that fits into a broader sense of their overall targets around net zero or other related ambitions that they may have. So I think what we're really trying to accomplish in our platform is to ensure that we really are getting it done on the ground at scale.
Great. No, it's really interesting to hear how there are different solutions, and we need all of those, right? We have to take everything. I was wondering if you could talk a little bit about how I believe you started in the US, more like the timberland, and then you expanded into emerging markets. How difficult it was for the investors, and often we hear, people are it's more harder to get the investors into emerging space. And could you talk a little bit about that process and the risks, how they were perceived, how you overcome the challenges on that?
Happy to. As I mentioned, we're active in Brazil and in Chile, and I think most timberland investors view Chile as a more developed market, and so I'll focus a little bit of our experience in Brazil, which does have kind of the categorization of an emerging market in several different areas. And I don't know if this is spoiler alert, but I don't know, the headlines, they're designed to generate clicks and excitement and consternation. I think the press is here to stress us out. And what we found on the ground, almost universally, is that the conditions on the ground are much different than the headlines you read. And so let's talk about Brazil for a minute. We've been active in that space since 2009. We deployed capital at scale in 2012. We've been through 4 different presidencies. We've seen the real depreciate by 2/3 over that period, but we've been able to deliver very strong US dollar returns. For a variety of different reasons. When you really look at a emerging market, I think it's very careful, in this space, we have to look through kind of the overall risk profile of a country. You have to look through the sovereign risk ratings. You have to work through and look through the specific risk assessments that have been done. You need to integrate them, but on the ground in this asset class, it's very specific to where you're operating and how you're operating. So for us, I think it's just been a very strong alliance with local practices and culture, leveraging what a country like Brazil does well. That's growing trees, silviculture, and being smart, and then figuring out ways that we kind of interplay and kind of advance their business along the lines with our clients' objectives. And that's where we get really excited with some of the work we're doing in the NBS space, is that we've been able to deliver these sorts of results in the operational setting, but now we're able and confident in our ability to deliver that in an NBS space, which arguably is more complicated, more interplay with social and natural ecosystems in a different way, more complex. However, we're very comfortable how those risk profiles play out. And I think at the end of the day, it's individual investors' risk appetite that will kind of drive the risk premia that is required from a financial point of view. But the operating environment is we're very comfortable with it.
Great, thanks for that. Maybe going through a bit backwards also on this risk return, because obviously one of the big issues around the imbalance between risk return ratios and obviously what's your risk discount and what is perceived risk and real risk. And I think we heard Indonesia, indeed, there are some really serious political risks. Obviously, there are insurance solutions emerging. Maybe if both of you could reflect on, first Andrew and Alexandre, on how do you present that? How do you overcome this? The risk part.
Sure. So one of the challenges for us with natural capital is just the lack of data out there, and in particular beyond the 2 sort of NCREIF, Forestry and Ag indices. So a lot of people do use those as sort of representations for the overall asset class, which clearly has some limitations given it's much broader than that. But just using those 2 indices, we did a sort of multi-asset assessment and said, how would natural capital behave as an allocation within a diversified portfolio? What are the correlations, the sort of vol profiles, etc. And it's hard because there's different types of natural capital, developed markets, emerging markets, some which do the full sort of supply chain with private equity returns and owning sawmills, etc., versus just doing the sort of commodity side. So it is really hard to sort of get a clear expectation. You have to do it sort of case by case rather than at the overall asset class level. But at the overall asset class level, what we found is it has a high correlation with growth. Also, obviously, there is an inflation embedded correlation there in respect of the commodity side and in respect of if you're owning the land. but it has a low correlation to fixed income and low to negative, even lower with equities. So it does, as an asset class, behave very well from a diversification perspective in a multi-private assets portfolio, or even a public-private portfolio, which we're looking at too. But from a return perspective, today, we're still looking at, in developed markets, 4 to 6%, maybe 5 to 7% is what we're underwriting strategies to. Some maybe 6 to 8. We certainly see some at 10 and some that have delivered well over 10. So it's not to say all things are equal, but we like to be conservative and take a long-term view of things. And that's the tricky thing at the moment with rates at 3.5, 4, 4.5 going up, is what is that sort of risk premium that you get over and above sitting on cash? The liquidity premium just doesn't seem to be there in a lot of places. That's not to say that those returns won't go up through time, and who knows what the future holds. But it's not as obvious today for us as it was when rates were zero to sort of lock in that long-term duration asset. So we are sort of thinking about how rates, it's difficult to know, will play out, what that will mean for the strategies we're investing in, how to think about that from a long-term perspective. The even more challenging side for us, and that's why we've been more cautious, is the NBS side, and thinking about the price curve for carbon, or emerging biodiversity markets. There it's really tricky, and we do see a lot of managers, and there's some great consultants out there, or great organizations providing estimates on that, but we all know it is very, very difficult because they're all generally sort of sloping upwards, and none of them sort of foresaw what we've seen in the last sort of 12 months, and I think we can expect a lot more of that going forwards with all the uncertainties out there. So that's a more tricky thing. I think if you can get an offtake agreement when you're investing in NBS to lock in the spread, and so if you're manufacturing a carbon credit for $5, $10, if it's in the sort of red space, maybe cheaper, and then you've got a buyer on the other side for 5, 10 years paying 15 or 20, then you can sort of de-risk that strategy. Also de-risk it through, obviously, some form of concessionary capital, which there is lots out there. And so as Justin mentioned a moment ago, policy really is going to play a big role here. Grants from environmental ministries, support from local actors, sovereign wealth funds, utilities. There's a lot going on, actually, to make this work. So I'm excited about it. You just got to think about the underlying risks.
Yeah, no, fully agree. And the issue with biodiversity credits, obviously, I think we are there where we were when 2013 with Althelia. There is not yet the asset, there is not yet demand, so it's really hard to get an offtake. However, I believe that we need to start piloting, right? So is there an opportunity maybe to think about, for this high-risk, sort of darker NBS side and the dark green, or sorry, not dark green side of the equation, to allocate maybe a small portion of a larger pot where you don't mind, even if you lose it? I mean, looking at Schroders, around 740 billion AUM, if you took 1%, it's 7 billion. That would be taking us very far. So what's the opportunities, and I'll come back to you, sorry, just to follow up on that, and also the same question to you. How can we think about maybe creatively we need to put some capital at risk, but as you say, the reward is very high, and will probably pay off monetarily and also non-monetarily, non-financial KPIs. So is there an opportunity maybe to think differently and tap into larger sources and a small portion and put it at risk even now, even though we don't have the price data and we don't have everything figured out yet?
So a couple of things there. I just mentioned about sort of conventional portfolio construction, but obviously with an impact lens, and I think the vast majority of people here, I would assume, are here under the sort of guise of sustainable investing. And so from that perspective, that's where we still are doing a lot of work and trying to understand what's the value of 1,000 tons, 2,000 tons of net sequestration in a portfolio from a per $1 million invested from a sort of climate mitigation perspective or carbon intensity perspective. What's the value of being able to show and talk about protecting intact nature and threatened species, et cetera? It's definitely valuable in the corporate arena. We see it in the sustainability reports, and it's coming important in the asset owner community as well. And so I think in some ways that will hopefully drive the investments, even if the return is commensurate with other things. It's more about commensurate returns with high impact. So I am optimistic on that side. Talking about asset allocation as well, one of the reasons that we're doing multi-private asset strategies, cutting across asset classes and thinking about how to do climate from a real estate perspective, but also what's nature positive real estate look like, nature positive infrastructure. We can think about in the context of forestry and farmland, but some of these other real asset strategies, it may be more of a do no harm type of approach, and like we have biodiversity net gain here in the UK. So I think to your point, yes, absolutely. If we want to be able to tell the story and have this sort of economic, environmental impacts that we need, then you have to size them accordingly. And it's most likely we don't sell them as single line items, but we sell them as part of a broader solution, and then you can get the sort of risk-weighted performance you're looking for.
Great, excellent.
Yeah, to come back on currency risk, so you have two very different type of projects. I would say RED Plus or restorations of wetlands. There's mostly OPEX, so you don't own any concessions, you don't own land. You're paid in dollars. Your VCUs, carbon units are paid in dollars. You invest in dollars. So I would say the risk is minimum. The difficulty is here to scale this type of projects. Just spending OPEX, you're pretty limited. If you scale, if you start to do afforestations in Latin America, of course you own land. You will have, and you will be dependent on the exits. Maybe not. Carbon will help. Some of the projects you will rely only on the carbon on the long term. So I would say that's plantations for conservation. But some of them, it's plantations for timberland. You benefit from carbon. Carbon is boosting the returns by, I would say, 3-4 points, depending on the assumptions. But then you have to exit your plantation at some stage, or you have to own it for 30 years. And if you want to exit, you need to reach the right scale. I think if you don't have a plantations of 100,000 hectares, I don't think many industrials would be interested by the projects if it's 10,000. So that's the challenge of scaling something in this area. Here you would have political risk, and you will have as well currency risk. Of course, it's difficult to avoid. What we think on the long terms, there's so much biological great environment for growing trees. There will be demand for trees, for wood in very different forms. So we think the dynamic on the wood is strong enough on top of the carbon to have something that should work on the long terms. But the time horizon could be pretty uncertain. Back to your point on the 1%. I mean, it's always difficult to say to a client, we put 1% at risk and you will lose everything. And on top of it, you have teams that work on it that are aligned with the work they do. So. But I think this is part of corporate responsibilities in large institutions. That's the beauty with them. At some stage, they want to spend on some. Initially, we were spending small amount of money in multi-impact themes. It was 200 million here, there, and. But when we say now we want to do 500 million on access to healthcare for underserved population, 500 million on nature-based solutions. Out of the blue, it became an asset class where we had to go through risk management, review all the terms, all the different risks. So I think there's a road. I don't think that the road where you say I can lose it is the right one. We must convince people that it's a true dual bottom line of financial returns and impact. And back to one point that Mike was saying about operating. I think the biggest bottleneck for us on scaling projects is people on the ground. I mean, there are great foresters in many countries, but people that are able to work on landscape designing, optimizing conservations, dealing with biodiversity, running all the paper that is needed for doing a carbon project, that's pretty huge. So I think that expertise doesn't exist. So we've dedicated 25% of the capital we have to invest venture capital in those small developers, help them grow their expertise, grow their teams, and then we finance their projects. So it's a way for us to be sure that in terms of risk, we have a good control over the way they underwrite this stuff. And over the long terms, I think they will bring on many other investors besides us But I guess that's the biggest bottleneck I've seen on top of other things that I've mentioned, is being comfortable with people on the ground on their ability to deliver. I mean, those projects, they will be around for 10, 15 years. So you need to be pretty confident on this long-term stability of teams and skills, expertise. We don't want dreamers. We want. I was having dinner yesterday with someone in the room, and we say we don't want dreamers on nature-based solutions. We want dreamers that execute.
Agreed. No, it's great to hear that you're investing in the ecosystem, and fully agree that we need to keep building that local capacity. Do you think that insurance products, have you seen any? Obviously, AXA, this group is working on many, but can help convince the investors of the risks, some of the risks?
Yeah, we're not that involved at this stage with the retail. We're much more on the general account of the companies. It will come. It's small amount. I've heard about tokenizations. I'm not too involved in that for now. It might come. For now, I think it's pretty complex to explain. But the insurance agents, they love the story, but they are pretty limited in terms of the liquidity that we can offer.
Yeah.
I think that's the biggest hurdle for them.
Great. And how about pension funds? So one of the challenges, and I think here often, that it's hard to get them involved. Is there any ways, do you think, we're obviously talking about small ticket size, too much risks. Do you have any of you, Mike, maybe you wanna, I think you're working on that aspects, but happy to take comments how we get them involved. Are they ready to jump in?
Yeah, sure. I mean, so I think this response can kind of integrate a lot of what we've been talking about. I think we at FIA, again, we're kind of an agents of execution, and we're looking for scale because our pension funds require that, and their ambitions are gigantic. So when we think about kind of where we've seen execution work and scale, we have an active mandate currently that is looking at a broader accounting of their carbon budget, and they're looking how forestry plugs into that overall carbon budget. So that's a very scalable solution. And the change really revolves around the portfolio allocation exercise, how they're constructing the portfolio at the very highest of levels. So that's kind of the opportunity where you're kind of creating more of a carbon constrained portfolio that is really affecting the investment decisions that the pension funds are making. And at that scale, that's where we see opportunity to execute, and where forestry fits into that. Second kind of opportunity we see is really on that execution side and NBS. It's very difficult to get scale and pure NBS exposures currently, given the construction of the markets right now. So one of the actions that we're taking is how can we kind of create perhaps a backbone of traditional forestry, sustainable forestry, because we're going to need wood. I think most of us here know the amount of wood that's required by 2050 just from sheer population growth and consumption is going to increase at a base case 37%. So we need to continue to grow wood. We can't lock up the resource. We need to continue to produce sustainable timber. So that portfolio constructed with a backbone of traditional timber, sustainable timber production, where we take significant bets across an NBS spectrum in a variety of different projects. We don't expect any of them to go to zero. However, we have a portfolio diversification approach there that allows us to scale with the backbone of traditional forestry and allows us to get action on that allocation of the portfolio that goes towards NBS outcomes.
Great, thanks for that. Any other comments on pension?
I mean, for us, the pension community is a more advanced channel. Definitely, as Mike mentioned, big investors already in forestry and farmland. So taking to them, I guess that third pillar of conservation has been interesting. Definitely interest from a sort of corporate sustainability perspective, and often if the corporate is of the pension plan making bold statements and commitments, then that can follow through to the pension plan as well. So that's really encouraging. I think it's just around the intermediary channel, which is also a very big channel that we've done a lot of work on and see a lot of excitement in this space. This is a very emotive subject, and so people, if they can create their organizations to fund nature preservation and climate, avoidance of climate change or mitigation against climate change, they want to do it. It's just finding the right structures that have a bit more of a pure exposure. Thus far, a lot of it's been more indirectly through public listed equities. We see a lot happening on the private equity side as well as been talked about. So I think there's a bit of a journey for the intermediaries to go on, as well as around the structuring as well. We have obviously listed trusts here in the UK and a new carbon designation on the London Stock Exchange to allow for listed funds to pay out carbon credits by way of dividend, which I think is a great innovation. So hopefully we'll see more in the listed space for intermediaries, because I do see very strong demand in that channel.
Great, thanks for that. Any additional comments, or we open up?
No, I think one thing that should convince you was what Justine was saying. 35% of potential GHG reduction is coming from acting on nature, including nature-based solutions. So I think this should be convincing enough, but it's not. I think some of the order for pensions for institutional clients is the understanding of carbon market. It's pretty complex. You have this compliance market, you have the voluntary, who plays in what market, what are the different driving factors of those markets. So I guess there's some education as well to be made and some track record to be delivered. But unfortunately, to be able to deliver track record on NBS solutions takes time. So we have a track record on small investments from the early days, but on a very scaled up project that is not available. I think some of the industrials, like the big paper company, the Star, the UPM, they've been in emerging countries, they've been on the ground, and they are changing. I think some of the change as well can come from those large corporates that are active in the wood industry, in the wood business. That's my hope, and then it will expand to some others. And you can see that I can say the large polluters, the big oil companies or the palm oil plantations, they are the first one to do projects. So it might be controversial, but they're active on the ground trying to do projects. Even the restoration of peatlands, it's coming through palm oil concession owners. So I guess there's a change of mindsets, and we can see every day the reality of climate change. In Europe, disappearing of nightingales, but everywhere in the world. So I think that might trigger something at the investment committee level of those large pensions, because today it's a long process to get them to new asset classes, but it will happen.
Yeah,
I'm confident.
Great. Maybe we can open up for the audience. I don't know if you have a mic. I think we have some mics. Any questions?
Hi, thanks. That was really interesting. My name is Mo. I work at Climate Impact Partners. I don't know if we're supposed to introduce ourselves, but hello.
Thank you.
You raised some really interesting points around the risks that these kind of projects have, like political risk, climatic risks, currency risks, etc. I wondered if you priced those risks into your IRR expectations, and how do you kind of fundamentally deal with the fact that nature-based solutions, specifically native restorations, tend to deliver credits later in their project lifestyle. So the IRR returns come a lot later. And so if you have higher IRR expectations which come later, do you think that's kind of aligned, or how do you respond to that for your investors, for your stakeholders, etc.? Thanks.
No, it's true. It's a challenge probably, depending on the project. If you do RED Plus project, you start to receive credit on the first year. So that's very different, but it's mostly OPEX. It's the lowest cost of carbon, a RED Plus or even a WRC, wetland restoration. When it comes to afforestations, projects of afforestations in South America, of course you have this long-term risk. So it means that you need to get to IRR that I would say are in the mid-teens, including the carbon. But think of plantations, traditional plantations in Brazil or Paraguay or in those areas, probably in, I would say 10, 12. Mike, correct me if I'm wrong, but I would say 10, 12 without the carbon. So that's the market reference for something where you don't harvest tree for the first 7, 8, 10 years. Here we benefit, because we on degraded land, away from traditional industry, we benefit from 3-4 additional points of carbon, maybe more. So that's why, back to the point of Andrew on the fact that rates are now 400 basis points, 500 basis points. It's the complexity of managing those long-dated assets. But I don't think there are many asset classes that can deliver 15% returns over an horizon of 12 years. When you look at infrastructures, renewable, it's much lower, I would say 6 to 8. So we're in a different range. Of course, there are additional risk, but I think it's a good risk, and you have the impact. I don't think that all of that emerging nature-based uncertainty will work without the impact and the importance of delivering positive biodiversity and carbon outcome for the investor.
Great, thank you. There was one here and one there.
Thank you. Super interesting panel. My hypothesis for people not raising their hands in the beginning actually comes from the fact that I don't think that we have a clear definition for a nature-based solution yet. And we've read between the lines of the discussion, what can it be? But compared to climate change, I would say, which has quite clear measurement of carbon dioxide and CO2 equivalents, when you talk about nature and biodiversity, it's a completely different story. And we are missing maybe the definitions and frameworks to measure that. So I would ask the panelists that, how do you, when you are talking about nature-based solutions, what's in it for you? What are the taxonomies or frameworks, indicators, measurements you are using when you are talking about nature-based solutions? Thank you.
Great question.
I can say a couple of words on that. Yeah, it is really confusing, and I still think there's a lot of iterations around what's the right sort of labels and right ways to sort of frame things. But for us, natural capital, we just started looking at the real asset, forestry and farmland, and rightly or wrongly, because it's what's out there today, that's kind of what's fitted in that bucket. The conservation is this newer area, and I think the difference between natural climate solutions and nature-based solutions really is splitting hairs here. There isn't that much of a difference, but if I could really try hard to draw a difference, nature-based solutions you can have for biodiversity loss as your primary goal, and nature protection and keeping nature intact, and there are some supporting market mechanisms for that today. There's a lot more that needs to come. But if your emphasis when looking at an investment is climate change and you want to optimize for that, so there's a good question to ask yourself when you're underwriting strategies is, what is the strategy optimizing? If it's impact, social, climate, biodiversity, and sometimes you can optimize for all or get a nice balance. In many cases, it's very clear you can optimize for one of those three. And in some cases, is it the harm or potential harm of those other two? And so that's, I think, where it gets really interesting. The asset class, largely in the past has been very much commercial oriented, definitely under sort of minimum sustainability standards. But I think the new lens and new expectations, certainly as we've been through this process with Blue Orchard, to be put on managers is very, very high around all of the sort of impact goals. So I think a lot of work's to be done. I think it really is just around those sort of motivations. And generally, I would say in our conversations with institutional clients and some intermediaries, the primary goal over and above return, risk and return and diversification, is climate at the moment. There's a recognition of the nature side, but because it's lagging in terms of its sort of market mechanisms, it's lagging in terms of its strong definitions, it's sort of hard to sort of demonstrate the data, the technology, everything's coming, but it is somewhat behind, and therefore I think you need to be careful to try and not kind of be caught wrong-footed and be sort of detrimental to nature. But that embedded optionality could come through time. So we sort of underwrite things as if we can get confidence on what is measurable today and sort of market standards and other things will emerge. That could be embedded optionality, hopefully to the upside.
Great, thanks for that. Yeah, one more last question. I feel, yeah, thanks.
Good morning. Yeah, Phil Cottle from Forestry. I had a very interesting point you made at AXA about 25 million in local capability to work with and develop projects. Two questions, really. Are you getting any money from local governments, national governments, for that? Second question, where are they being trained? Are they being trained overseas or locally in universities? What's the plan? And maybe the third question is what FIA and Schroders are doing in this front, because it always seems to me that is the weakest point of the whole business is local expertise, working with communities.
First question was on the.
You mentioned 25 million in developing local extension and project development.
I think there's like 25%.
25%.
Yeah,
it's more 120, 150 million of private equity investments in venture developers.
Right. And where is it being done? I mean, how are you creating this expertise?
It's been done thanks to the networks of people that have been in the business for 10 years. But some of those investments, they dates back to like 2014, 15. For example, Forest Carbon Indonesia, it's the developers of wetland restorations. We've been with them for 8 years. We financed their first projects, and now we're expanding. We put a strategy from Indonesia into the capital. So the idea is really to build up the expertise with people that have a very strong know-how, whether it's the local communities or the carbon markets. It's for them to expand. It's really, we don't take the control of the company. We are the biggest minority investor in the company, and they grow the company. We sit at the board and we help them growing and find other investors. We are not doing that with governments. We have a lot of discussions with the big bilateral bank and regional banks, but it takes time. And sometimes we cannot afford to wait for 2 years to have sign off from all the different committees. So we progress, and then governments are very helpful. Very helpful. If the projects we do in Peru, for example, they happen thanks to the governments, with national park, local NGOs. The way we get involved with these communities is a lot through the NGOs. I think they are very keen in the process, the local one, the small one, not the large NGOs of the world. And it's time. It's time. It's trust. It's for them to get wake-up calls on how they can act on the nature. At the COP15, everybody was saying that they are the guardians of biodiversity and nature, and it's true. They live with nature. They've managed to adapt to nature in a different way than Westerners have done it. So I think. That it's an effort that it's worth spending, but us from London, from New York, we cannot do it. We rely on our local network of developers where we've put capital.
Great. So unfortunately, we run out of time. I'll ask for 1 minute so that I can ask the panelists in 30 seconds to give your one top recommendation to your peers who are still sitting on a fence. Mike.
Recognize that carbon markets were first developed in the late 90s, and now here we are today, and these things have taken time, but now we have groundswell behind us, and I think tailwinds behind us in that space. We're going to have the similar kind of developments in NBS, but I think it's going to be much faster. And I think that we all can align that we want to be ingrained and moving fast with that change.
Thank you.
Yeah, I just think maybe it's the question a moment ago is just to really do your diligence and sort of research on the space, especially in these emerging areas. There's a lot of predictions over what will happen. It's very hard to know. The previous question before around policy risk, that is huge in terms of what support there'll be for the carbon markets, whether it be regulated or not, whether you can export carbon credits if you're investing in a local project. We see Zimbabwe putting question marks on that. Many other countries done that too, and I think you'll see more. So it's really investing in something where you can get some assurances. Obviously, governments can change, policies can change, but I think it's kind of working with the known unknowns and who knows about the unknown unknowns. Hopefully they'll come out soon, and things will be clearer. But there's a degree of kind of forward thinking here, how the markets evolve, and that provides the opportunity for those who get involved early.
Thank you.
I would say spend more time with people like us. You will see amazing things that can be delivered. We're not in a hurry, but the planet is. So I would say don't hesitate to reach us, and I think a lot of people in the room have been active in that space. So there's a lot, and it's actual things. It's not dreams. I reiterate the fact that this is not dreams. Projects have happened. Biodiversity has been saved. Community have been helped. They receive carbon units as well. So there's a reality behind those nature-based projects, even if it's more complex than traditional equity investments. There's a reality on actions being done on the ground and things being delivered.
Perfect. On that positive note, thank you very much for your attention. Please join me thanking the panel for this excellent discussion.
Thank you.
Thank you.
Alex.